Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis welcoming you to the final Money Talk podcast for 2023. It's Friday the 22nd of December. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the Biden administration is reportedly discussing raising tariffs on some Chinese goods, including electric vehicles, in an attempt to bolster the US clean energy industry against cheaper Chinese exports. A bipartisan group of US lawmakers is urging President Joe Biden to block Nippon Steel's $14.9 billion purchase of US steel on national security grounds as the takeover faces a political backlash in Washington. US economic growth and inflation were slower in the third quarter than previously reported, supporting the potential for a soft landing. The American economy expanded at an annualized pace of 4.9% in the third quarter, slightly below 5.2% in the second estimate. Angola has said it's leaving OPEC in a blow to the oil cartel. The decision comes after the producer group lowered Angola's oil output target last month as part of an ongoing series of cuts led by Saudi Arabia to prop up prices. After 16 years, Angola's departure from OPEC has heightened concerns about the organisation's ability to stabilise global prices amid disputes over oil production quotas. On today's programme, I'm joined by Francis Lun, the CEO of Securities, and David Roche, President and Global Strategist at Independent Strategy. And with a view from South Korea is Peter Kim, Head of Global Investment Strategy at KB Financial Group in Seoul. And if you want to get in touch for the final time this year, please go to my website, peterlewismoneytalk.substack.com. And while you're there, please take a look at my Asian newsletter, updated every business day.
Peter Lewis's Money Talk.
On Wall Street, US stocks advanced on Thursday after recovering from their biggest sell-off in 3 months in the prior session, with the latest mixed economic data adding to expectations that borrowing costs could ease next year. The S&P 500 added 1% to 4,747, leaving it a little more than 1% away from a new record high. The Dow gained 322 points, or 0.9%, to 37,404. Meanwhile, the Nasdaq Composite advanced 1.3% to 14,964. The global bond rally took a breather as the yield on the US 2-year hovered around 4.35%. The rate on the US 10-year edged up 4 basis points to 3.89%. The US dollar resumed its slide, falling against all of its group of 10 peers Thursday. The US dollar index dropped 0.6% to below 102 and nearing its lowest level in 5 months. Gold gained 0.8% over the session to $2,044 an ounce. Brent crude oil futures fell below $78 per barrel at one stage on Thursday after Angola said it was leaving OPEC. Brent crude oil settled 0.4% lower at $79.39 a barrel. And Hong Kong stocks reversed earlier losses. The Hang Seng Index, which was down 1% at the open, turned around to close 7 points higher at 16,621. Chinese A shares also rebounded. The Shanghai Composite ended the day 0.6% firmer at 2,919. And it looks like the Hang Seng projected to open about 70 points higher this morning. That's around 0.4%. Futures markets pointing to a start for the index of about 16,690. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk.
Peter Lewis's Money Talk.
And for the final time this year, we welcome our regular Friday morning commentator, Francis Lun, the CEO of Securities. Morning, Francis.
Hi, good morning.
And also with us is David Roche, President and Global Strategist at Independent Strategy. Morning to you, David.
And good morning, Peter, and good morning, Francis.
Let's start with some trade protectionism news. The Wall Street Journal reported Thursday that the Biden administration is discussing raising tariffs on some Chinese goods, including electric vehicles, in an attempt to bolster the US clean energy industry against cheaper Chinese exports. Also, China has banned exports of technologies for processing rare earths as President Xi Jinping's administration hits back against US-led curbs on advanced computer chip sales to Chinese companies. And China has suspended tax concessions for 12 chemical compound imports from Taiwan in retaliation for what Beijing deems to be a violation of a trade agreement. And Brussels has launched an anti-dumping investigation into imports of biodiesel from China. I mean, Francis, seems like we're exiting this year and entering the new year with trade protectionism, tariffs, restrictions, nowhere near being resolved or being eased.
Yeah, it's a terrible situation. Actually, it started with the Joe Biden's Inflation Reduction Act. The act was designed to bring electric car manufacturing to the U.S. So, because Chinese companies own about 60% of the global resources for lithium and actually produces something like 60% of the car batteries. So, the only way to get around it is have a strict U.S. content. That is what the Inflation Reduction Act specifies. That just about everything from raw material to the battery you make and for the electric car, everything. You must be made in the U.S. to qualify for the $7,500 in subsidy. So this is definitely a trade war of for the U.S. against China. Because the Chinese already have a dominant position in electric car vehicles.
It seems, doesn't it, that this Inflation Reduction Act, it's nothing about reducing inflation. It's more a new industrial policy for the United States designed to sort of immune itself from competition from China.
Yeah, definitely. It's ironic that the U.S. talks about free trade, and they only talk about free trade if it suits them.
Yep. David, we're sort of becoming immune to this, aren't we, really? We sort of assume now that tariffs have become the norm, whether it's, China, whether it's the US putting tariffs on Chinese goods, China retaliating, then we've got EU-China problems. Is this any way in which this can be resolved?
I don't think so. I'd say there are several levels to this. First of all, the division of the world into warring factions on the one hand, the kind of alliance of democracies, and on the other, the alliance of totalitarian states like Russia and China, are the bedrock of what this industrial policy, as you rightly called it, is all about. What is the industrial policy about? It's actually an accelerated form of ending globalization and carrying out deglobalization by repatriating industry and everything to do with its know-how to friendly shores or to your own country within each alliance. So I would say that this is going to get worse, not better, over the next couple of years. And it is all part and parcel of what is happening in geopolitics worldwide. And that is, of course, to put it mildly, the death knell of globalization and its reversal into these sort of industrial policies, which you're going to see pretty well everywhere in the two blocks which confront each other. So no change, and I think it will deepen and get worse.
It seems, Francis, doesn't it, that the US just doesn't want any sort of competition, doesn't want any sort of foreign acquisitions of its companies. We're seeing now US lawmakers urging President Biden to block Nippon Steel's purchase of US steel, even though, Japan is supposed to be the US's biggest ally in Asia. It doesn't seem to matter, does it?
It doesn't matter at all.
Well, you're moving into an electoral period in which people are going to compete on the basis of the most inane and stupid ideas. Now, I don't actually think that a lot of what is going on about deglobalization is either inane or stupid. It's simply substituting the achievement of security at the price of productivity. But I think, of course, the opposition to a deal by an efficient Japanese steel producer to buy a U.S. inefficient one, that doesn't fall well into the jigsaw. It's incoherent and it's stupid. But that's electoral time. What do you expect?
Francis, what do you make of this? It's as David says, it's quite an efficient Japanese company. Maybe in some ways this would be good for US Steel.
Yeah, definitely. Actually, US Steel used to be the largest steel maker in the US, and then now the U.S. should concentrate on the things that they do best, like semiconductor and the internet, things like that. And they are losing out on the basic manufacturing, including steel making. I think Japanese and Korean steel makers are much more efficient than they are. So it's better that they let the acquisition to go ahead. Otherwise, U.S. Steel will run into bankruptcy several years down the line.
It does seem, doesn't it, hard to imagine why steel production is a national security issue. It seems that national security is raised every time now as being the reason as to why certain mergers or acquisitions can't go ahead or certain things can't be imported or exported.
Yeah, definitely. Not only that, they raise national security in the case of something like shrimp from Vietnam. So it really what it really matters is the votes for the congressional district. So it's all politics instead of really trade consideration.
David, I'm wondering, obviously we've known for a while that US-China relationships have been difficult, but I'm wondering as we move into 2024, are EU-China relations in an even worse state than US-China ones? Because at least there have been some signs maybe of the US-China relationship stabilizing, but it seems that the EU and China are just talking past each other at the moment.
Well, I think that's right. There was a very recent EU summit with China, which really was a dialogue de sourds. It was a dialogue of people who were deaf or dumb or both. But it's quite clear that there's no common ground at all. The so-called comprehensive investment agreement, which was, virtually drafted and agreed to a couple of years ago, that is completely dead in the water. You couldn't get it through the European Parliament, which would have to ratify it if you tried. And I would say that the Europeans have woken up to the fact that what China was trying to do with trade and its investment and everything else was to actually break Europe asunder. And buying Greek shipping ports. I mean, actually owning about 30% of European shipping port capacity. And, building roads in Bulgaria and stuff like that, trying to separate out the weaker members. Hungary included in its recent visit, got all sorts of electric plant, electric vehicle and battery investment from China. But, the Europeans have woken up to this, so it's not going to work. And I would have said that Europe may be trotting along behind America, but essentially the attitude on trade, the attitude on deglobalization is going to be the same. Now, of course, the big losers from this in Europe, in particular, the car producers. But that's just going to be, in a sense, collateral damage. The policy is not going to be shifted in the favor of European or, in particular, German car producers. That's not going to happen. So it's very much the same output. It's the same chapter, but it's, in a sense, the US has gone further on, and Europe is coming up from behind with an increasing awareness, but you're not going to be able to put much air and gap between the two policies by the end of the year.
Okay. Let's turn our attention to the central banks. The PBOC left its benchmark interest rates on hold. The one-year loan prime rate, which is the peg for most household and corporate loans in the country, left at a record low of 3.45% for the fourth consecutive month. The five-year benchmark loan rate, which is the peg for most mortgages, that was unchanged at 4.2% for the sixth straight month. Francis, as we move into 2024, a lot of focus on the Chinese economy and what the government can try and do to support it. Clearly, it doesn't like lowering interest rates, does it? We've learned that already through the course of this year. But what can it do to try and help the economy?
Well, I think it can release more liquidity into the system. The crux of the problem is really the bad property loans. I read somewhere the property loans make up or something like 20% of all bank lending. And most of them are really going sour. There are very few liquid property developers in China now. Longfor is one of them, but for the private ones, they are all they all defaulted, and it's difficult in the current situation. Even if you lower interest rate any further, you cannot stimulate demand. The problem is there's just too much money tied up in bad property loans, and especially for the average citizen who bought unfinished properties. They still have to pay the mortgages, make mortgage payments, but they have nowhere to live. And that's created a lot of discontent. And so I think I don't think the central bank is really addressing the real problem for the poor demand. I think it has to do on the policy level how to resolve the property crisis.
David, if this property crisis is going to be resolved, someone's got to bear these losses, haven't there? There are enormous losses in the system sitting on the balance sheets of banks, of local governments, of off-balance sheet financing vehicles. Someone somewhere, these losses aren't going to go away. Someone's got to bear them, haven't they? And it seems that the Chinese government wants to make the big banks bear quite a lot of it.
Well, look, Peter, we've talked about this before, and I don't want to repeat myself like a worn-out record, but until the problem of actually writing down the value of all the dud assets and the dud loans in the Chinese economy is faced, all of the money you can print to keep the old alive while trying to grow the new, all the money that you can spend fiscally building roads to nowhere, will not revive confidence, which is the missing factor. And unfortunately, to revive that confidence, you have to admit, rather like going to confession and doing your penance in the Catholic Church, you have to admit the errors of your ways and face up to the reality you described. Now, to admit the errors of your ways, unfortunately, means that the biggest loss would be in the credibility of the Communist Party, which is why under the leadership it's got, it cannot actually turn around and do the things that are needed, because to do so would be to admit that a lot of the policies that are in place have been mistaken.
And also they would have to unwind quite a lot of the growth that they previously reported, because it's fictitious, really, isn't it? It's based upon these assets, which are really fake assets because they're not valued properly at their real value.
That's the nature of every bubble economy, isn't it? That you get these super growth rates, super productivity rates, happy workers, and lots of people making a bundle of dough on their flats, apartments, and houses for a period, and it looks great. But because the bedrock, the point on which all of this is pirouetting is overvalued assets inflated by incorrect policies, it comes tumbling down and goes into reverse. And the only way to reverse that reversal is to face up to the reality of what the real value of those assets are, what the problems with the legacy loans are, and more importantly, what the problem about the misallocation of resources, including labor, to things like construction, the things like real estate development have actually been. And you have to really do this. There's no secret about how you do it. It's been done in dozens of economies. But the nature of the bubble, as you correctly describe, is that the whole economic growth, the whole of that so-called welfare, was actually pirouetting on one factor, which is inflated asset prices, misallocation of resources.
And in a sort of a proper market economy, one of the ways in which that would resolve itself is through bankruptcies. These companies would eventually have to be wound up.
Yes, you do. It's as simple as that. I mean, if you were to look at any property bubble, and God knows we've lived through a lot of property bubbles, you and I, that is precisely what happened. You have to clean out the system like flushing the loo by allowing the bankrupt to go bankrupt. If you try and keep them all floating around in a sea of liquidity, you will neither have the confidence to make the economy recover, and nor will you have the economics to make the recovery possible.
Francis, I want to get your thoughts on the local markets as we move into the new year. The Hang Seng is down this month. It's down about 2.5%. It's slumped now for 4 straight months since July. It's down 16% this year, which is the worst performer among all the global indices. And we're going to see the 4th year of declines, which is actually the longest losing streak in the Hang Seng's history. Average daily turnover is down 40 in world history. Okay. Foreign investors, they continue to pour their money out of stock exchanges in Hong Kong and China. Net inflows this year now to the mainland markets have been reduced to the least since 2016. That's according to Goldman Sachs, and the CSI 300 on the mainland down 14% year to date. I don't want to ask you to predict, is it going to go up next year? Because it's very hard, isn't it, to call the bottoms on these things. What I'm interested in knowing is, what are the conditions that you would like to see to try and bring back confidence into the Chinese market so that we could maybe see a sustained rally at some point next year?
Well, the top 3 internet companies right now, ByteDance is TikTok, Shein, which is headquartered in Singapore, and then Temu, which is headquartered in Boston, of all places. And these 3 are the top internet companies, and they're drawing all the interest. And they have taken over from Alibaba and Tencent and JD. So if we want to revive the Chinese and Hong Kong stock market, you have to bring these 3 companies back to Hong Kong and China. Because you cannot expect Alibaba and Tencent to perform miracles. They have done that, and then they have passed their prime already. They are not the most innovative and high growth company as it used to. So bring the high growth companies to Hong Kong and China, and then we will see a revival in the stock markets in Hong Kong and China.
But there's a good reason why those companies don't want to be in Hong Kong and China, I presume, isn't there? Why C is, for example, headquartered in Singapore as opposed to here.
Yeah, that's right. Well, the Chinese government can do miracles.
It's very instructive, isn't it, to look at sort of, if you like, the demise of Alibaba, for example. It's no longer even the biggest e-commerce platform in China. It's been overtaken by Pinduoduo, both in terms of market valuation and in terms of sales as well.
Yeah. I just read somewhere that TikTok is taking more money in than Tencent already. Tencent used to be the most profitable internet company in China, but now it's TikTok. So I think the Chinese government must lean on whoever is in charge of TikTok and get them listed in China. or Hong Kong.
David, final thoughts from you. If we're going to see a revival in Chinese markets, both here in Hong Kong and on the mainland, what are the conditions that need to be in place so that we can start to restore confidence?
Well, I think in an odd sort of way, the markets would probably welcome most a clear sign that policy in China was changing towards the sort of policy which is surgical about addressing the various problems related to property. I think that would be serious, but it would be not based upon printing more money or spending more money, but on dealing with the problems of solvency and misallocation of resources throughout the economy. That has to be number one. And number two is any sign of a thaw between the US and China, whether that was because Trump or somebody better was to be seen to be the next president. Even if Trump, with his relationships based on transactions rather than upon ideologies, would, I think, be greeted by the markets as possibly a glimmer of hope. But obviously, Haley would be a much better candidate. That would be number two. And number three is a revival in global growth, which at the moment is looking very, very wan and meager. They would be my three things for the markets to go better, not just the Chinese market, but markets in general.
Okay. Well, look, thank you very much for your thoughts this morning, and thank you for your contributions to Money Talk over 2023. Wish you both a very happy Christmas and look forward to speaking again in 2024. You heard there David Roche, who is President and Global Strategist at Independent Strategy, and Francis Lun, who is the CEO of GEO Securities.
Peter Lewis's Money Talk.
I'm joined now by Peter Kim, who is Head of Global Investment Strategy at KB Financial Group in Seoul. Very good morning to you, Peter.
Good morning. Good morning. Happy holidays.
Happy holidays to you too. Well, look, let's look back a little bit at 2023. What a year it's been for macro fund managers. They've got it completely wrong, haven't they, this year? The consensus was at the beginning of the year, the US was going to slide into recession, weighed down by all these interest rate rises, and China was going to boom because they'd come out of COVID lockdowns and the consumer was going to go on a happy spending spree. Instead, we saw the complete opposite. The US has boomed and China's slumped. What's gone wrong?
Well, that's a long explanation, if we have one. I think it's clear now that this business cycle that we're in is unique and unlike anyone that we've seen before. I can maybe just cite maybe a couple of key differences. One is that after 30 years of massive free trade globalization, we have a pause or reversal of that. And that has put in a massive structural factor that has derailed anything that we've seen. Second is that we have a very unique situation of tightening monetary conditions, but everything else is very, very loose. So that explains the U.S. part. Then, of course, for China, you have the added variable of politics getting in the way of economic policy, unlike anything we've seen probably in the past 50 years. So if you look at the previous 50 years of normal economic cycles, we have those three factors that has derailed any ability for economists to put in a forecast.
And is there any of that going to change in 2023 or in 2024? Sorry, because if you look at China, for example, the politics are pretty well entrenched, aren't they? I mean, if you look at the problems in the property sector, unless the government is prepared to let these losses be realised, someone has got to take these massive losses that are sitting on the balance sheets of local governments, of banks, of property developers. Someone's got to take them somewhere, but the government would have to basically admit that it had got it wrong. It doesn't seem to want to do that.
Yeah, I mean, I think, we have politics winning over policymakers, clearly, and that's not just China. I mean, I think we have the situation in many other parts of the world. But sticking with China for the moment, you'd have to think that the status quo will sustain for many more years. I don't see real political incentive for them to change the stance that they've established this year and the past few years. For the US, it's a little more tricky, but I have to say that the recent surprising pivot by the US Fed on their interest rate policy has to be somewhat influenced by the coming elections.
And you think that's politics behind that? Now, obviously, the Fed would deny that, of course, but
one, I think, and it's not just U.S., right? I mean, I think the so-called independence of central banks is really become something of history now. Now, to a varying degree on which central bank you speak to, but I think we are entering into an era again where politics is winning over policymakers, and it's increasingly so. It's just a matter of degree.
So we go into 2024 now with the reverse, how we started 2023. Everyone now is very negative about China, and it's going to be another bad year for China. And the US is just going to carry on, growing it. We've got this Goldilocks economy, according to the macro analysts, of inflation that's coming down, an economy that's going to have a soft landing. So the reverse predictions now at the beginning of this year.
I'm always, whenever something is so consensus, I'm always looking for excuse to take the other side.
Yep.
I think, and we have that situation right now that, as you mentioned, that US is in Goldilocks, it looks great. China is now in a, decade-long derating, and then nothing's going to change. So, I'm tempted, and I will continue to seek the other side of that argument. But I think, judging by the rally that we've seen in U.S. equities and the continued underperformance of China, I'm tempted to call for at least a short to medium term reversal of those two markets, purely just because on valuation and purely because the fund flow is so crowded into both of those trades. But I cannot get myself to say that the structural story on both sides is going to materially change in the coming year.
I mean, if you look at the US, investors are sort of approaching the new year with a very large number of positive sort of assumptions priced into stocks. They're assuming the Fed is going to cut at least 3 times. Well, the markets is saying 6 times now next year. Earnings growth is supposed to carry on beyond what is normal and what is average. They're saying inflation is going to decline back to the Fed's target, and we're going to have this nice economic soft landing. It seems almost a bit too good to be true, doesn't it?
Oh, exactly. And let's just rewind back a few months ago and remind ourselves of those inflationary fears, and that inflation was going to be sticky. We still have geopolitical situation that's still not resolved. We still have China disengaged from the global supply chain. And we still have bottlenecks in many commodities. And I think that we have to remind ourselves that those 3 factors have not permanently been resolved. So I'm a little more cautious about it. But again, everything is relative to expectations as far as financial markets go. And I think at least in the short term, maybe we've gone ahead of ourselves, taking US as Goldilocks.
But the problem is, if you were sceptical and have many reasons to be sceptical, you would have lost out this year. The MSCI All World's up 19% this year, so it was down 20% in 2022. It's basically made up most of that plunge that we saw in 2022. But we've got this odd situation now where US stocks are surging to a record high, and bonds are pricing in a recession. Something doesn't seem right there either.
Yeah, I mean, And that's not the only thing that doesn't sync with the historical correlation. We have, you mentioned earlier that China in a deflationary phase, perhaps. Europe, I think, still it has a mild form of stagflation. And, most ironically, Japan is in a reflation recovery. So how about that for the world tipping on its head? But going back to bond market versus equity market, I think it's, again, I go back to what I said earlier, is that while we have seen official interest rates rise globally, everything else on a fiscal side and in terms of central bank balance sheet is at a historical high or very close to. So this idea that we have been tightening, you can look at some of the data coming out of the U.S. The retail participation, the wages are growing, central bank balance sheet is high, and the MMF balance sheet is massively at historical high. So you have a pretty good liquidity situation despite the official interest rates. Now, final point on that, Mr. Powell, who originally, remember, called this current inflation to be transitory. Now there are people saying that maybe it was transitory after all. So maybe he's personally motivated to prove everyone, himself and everyone else, that he was right after all. So that's a little irony once again.
But there are risks, aren't there, that to inflation on the upside as well? I mean, we're seeing all these supply chain disruptions in the Red Sea, over in the Panama Canal as well. We've got two wars going on. You can see there are risks to the upside for inflation, that it could come back again.
Definitely. And if we just sort of think about the typical election cycle for the U.S., you would have to assume that there's going to be a lot of fighting between the two parties over there. And perhaps whatever we spend on fiscal and monetary front to try to get the economy going next year may result in us paying dearly, or you Americans paying dearly, in 2025, 2026. So again, I do think that the short-term gratification that we are getting into may lead to long-term cost of growth.
And the other feature of this year is just the concentration of the market that we've seen in the US. The 5 largest companies now make up nearly a quarter of the S&P 500, and the 50 most valuable companies in the index are 60% of its total weight. This is very unusual, isn't it? We don't normally see in normal markets anyway that type of concentration, which then also leads to a lot of volatility as well.
Right. So again, the argument of value versus growth. I mean, we had value investors in the equities make a comeback, but unfortunately, that comeback wasn't very long. I do think that there are a couple of things at play here. First is that the retail participation is structurally taking up greater portion over the institutional money. That is continuing to promote this idea that stock market is now a combination of gaming and gambling rather than fundamental value, as financial theory will promote. A second is that ultimately, I do believe that very long term that we're still in a deflationary environment, even though we have inflation cycle. I think that there is a deflation backdrop that is structurally adding valuation premium for long-term growth stocks. So as much as we can talk about value versus growth and how it doesn't make sense, I do think that some of these long-term structural growth platforms will see premium sustain.
The retail investor does seem to be gambling, doesn't he? Because you look at things like these one-day options, for example. Retail investors are piling into options that expire the same day, which was apparently part of the reason why we saw this big plunge in the S&P 500 and the NASDAQ on Wednesday, because of the amount of put options that they bought. This hardly can be classified as investing, really, can it?
No, but I cannot argue against it because investing in stocks has always had that speculative premium to it, but that is expanding. I mean, I can point to you another example. Look at Bitcoin. I mean, it's now already approaching a historical high, and there's absolutely no reason, given the regulatory scrutiny, given the interest rate environment, for that speculation to go into cryptos after all we've been through. I mean, it's only been just less than a couple of years that we've had that FTX and crypto bubble so-called blow up, but here we are. So I think this current generation, young generation that are entering into stock market, either they are empowered by the inheritance they'll get from their parents, or they are just structurally and psychologically have no fear in punting their savings for that instant gratification. So I cannot say wrong.
It's a new way, isn't it? That has escaped us clearly. Well, look, Peter, it's been a pleasure talking to you this year. Thank you very much for your insights. Look forward to speaking with you again next year. And in the meantime, I wish you a very happy Christmas and Happy New Year.
Thank you, and same to you. I enjoyed our segments immensely. Look forward to more discussions. Happy holidays.
That's Peter Kim, who is head of global investment strategy at the KB Financial Group in Seoul.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you very much for listening this morning and throughout 2023. I really appreciate you taking the time to download this podcast and for helping to support independent broadcasting in Hong Kong that's balanced and fair. This is the final Money Talk of 2023 as the show takes a break over Christmas and New Year. Money Talk will be back on Wednesday, the 3rd of January, when I'll have the latest business and finance news from Hong Kong and around Asia, with analysis from our panel of expert guests, which will include Andrew Sullivan, founder of Asian Market Sense, and Nick Marrow, lead for global trade at the Economist Intelligence Unit. And with a view from Japan will be Tokyo-based journalist and author William Pesic. In the meantime, I wish you a Merry Christmas and a happy, healthy and successful New Year. See you in January.
Money Talk.